consensus and a pretty challenging outlook. And in many respects, with interest rates high, with central banks still looking to slow economies, growth being muted, better, but muted, and a war out there, there's sort of a lot of noise on the horizon, and we're getting asked questions from clients. Wouldn't it, given all the uncertainty, wouldn't it be better to be in cash? And the short answer is probably over the last year, with the joys of hindsight, probably would have been. And I'll go into some of the broader share market returns later. But I think that sort of just looking back through history is quite instructive at times. And if we go back to New Zealand all the way back in 1991, which was a while ago, but probably still fresh in the mind of some of us. If you think about 1991 at the start of the year or around the sort of first half of the year, what was happening? You had a Gulf War. So the first Gulf War in Iraq was sort of happened in late 1990s, so 91. You had a war going on. It had a really ugly period in terms of New Zealand shares, where in 1990 the New Zealand share market was down close to 40%. You had inflation in 1990, peaked at 7.6%. It was coming down, but in early 91 it was still 4.5%. GDP growth, negative, deeply negative. Q1 in 1991 was minus 2.4%. So you had an economy that was going backwards at a fairly decent rate of knots. And the flip side of that is life was pretty challenging in terms of unemployment, almost double digits. It did get to double digits during 91, but it's Q1 started the year at 9.8% and finished over 11, I think. As an interesting aside, that's one reason why I personally ended up doing a master's degree after my bachelor's, is that jobs were hard to find, and it was kind of easier to stay at university. Shows my age, possibly.
You just studied really early.
Yeah. And against that, cash term deposits were 9 to 10%. So, you had a lot of negatives on the horizon. You had cash looking pretty attractive. And then, again, for those who are around, 1991 was Ruth Richardson, finance minister, in what was sort of deemed the mother of all budgets. So she massively cut government spending and cut spending on, introduced user pays in healthcare and all of those sorts of things. So really sort of another strong contractionary force on the economy sort of coming in to what was already a really weak situation. So if there was ever a time probably in New Zealand to sort of run for cash, that might have been it. What was interesting, though, is what happened to the share market over that period. It had been down hard in 1990, as I said. 1991, it was up 25%. 1992, a more muted plus 4%. But then 1993, up 40%. So, whilst cash was attractive, still didn't outweigh being invested in assets over that period of time. And again, a little bit of a broken record, and people would have heard me say this before, but really our role as investment managers and the role of our industry is really to work with people to move them out of that default position, which is cash, and really into assets that have an ability over time, and it is that time issue that's the important one, over time generate returns that are better than cash, and they'll better compound that, and that's how you grow wealth.
The other thing, of course, is if you move into cash, so you mentioned earlier that it would have been better, perhaps, to be in cash. You have to have the foresight and the ability and I guess the moral fortitude, if you're nervous in that way, to reinvest in order to get the benefits down the line. And of course, markets move extremely quickly.
One, markets move quickly, and two, ultimately, markets are forward-looking, and people look to position for what is happening. So often in the case, I think 1991 was a good example. It was a really ugly outlook in 1991, but why was the share market up? Ultimately, the share market was positioning for what was a better economic scenario in 1992 and 1993. That obviously continued to come through.
After all the hard work was done.
Correct. Yep.
Which is something we'll be touching upon shortly. Okay, so we've got our 5 reasons for optimism in the current environment. The first one is earnings and valuations. Take us through why you believe that this is such a major contributor and the market, or I guess the less positive pundits and commentators aren't focusing on this.
I'm going to attack this from a couple of different ways if I can.
Right.
I think if we look back at the start of the year, is one of the things that, to be honest, even we missed as well, is that last year with interest rates rising, people very much viewed the mega cap stocks, the Microsofts, the Amazons, etc., as what you call long duration assets. Maybe Microsoft and Amazon, etc., are a bad example, but other tech companies where earnings were more likely to be large in the future than they are now. So with interest rates being super low previously, your need to discount those future earnings was much lower. So essentially $100 10 years' time was basically worth the same as it is today. Now with interest rates being much higher, $100 in 10 years' time is worth less because you get it discounted at, basically cash rates are 5 or 6%. So you can give less weight to money in the future. So that's sort of a long intro to say that people were very focused that technology companies were going to be very impacted by interest rates. And certainly last year they were. But in retrospect, what was missed is really, why have those companies done well over the last, probably last decade? It's because they have remarkable earnings power. And in that respect, a lot of what has happened this year, and you've seen really quite stellar performance, what they call the sort of Magnificent Seven, those big mega cap stocks in the US, and it's really driven the market, is that the earnings power of those businesses has come through, even though growth has been better, but it's still been quite muted. And it was certainly a point one of our external managers has been making, Fisher Investments out of California. Caught up with them recently, and they made the point that from their point of view, the way they're very much what we'd call a top-down investor, a share market investor, so they look at the economic environment and the positioning of the market. And they're really saying that if you have a period where growth is muted, and their view is that, one, we've been in that for some time and still likely to be in that going forward, that you don't really want businesses that are dependent on economic growth because their earnings will be muted. But you want businesses on the flip side that have an ability to drive their own growth, and that's very much that tech space. So those earnings have been there, and that's really definitely kept up the market. At a wider level, though, again, I suppose if we think about where we were coming into this year, really the consensus was uniformly that it was going to be a tough year in terms of economic growth, and that earnings would be tough. And for the first basically for the first half of the year, that was probably true. We've seen sort of US quarterly earnings have really sort of dropped for 3 quarters in a row, sort of end of 2022 and the first 2 quarters of 2023. The most recent earnings update is actually, on average, companies did pretty well. They're up earnings are now up about 4%, 4.5% year to date. So that's not particularly, that's a relatively positive outcome, especially in the situation where beneath the hood you've had a couple of sectors, things like energy, so obviously oil, they had massive earnings uplift in 2022, so they're coming off those very high numbers, so they've actually had some quite steep negative numbers. And equally some of the materials companies, so steel and things like that, which again, because they're coming off the back of that COVID supply side squeezes, are actually seeing some negative numbers. So actually, in many respects, earnings are good. And if we look forward, probably these numbers will come down, but at the moment, expectations for next year are for US earnings to be up about 10% in 2024. So that's a pretty rosy number. I'm probably a little skeptical it's going to be that good, but that's not bad. So from an earnings standpoint, things are a lot's priced. I think people are priced in the negative news, and they're now being a little surprised by how good some of the earnings are coming through.
Okay, and so that's very, US market centric, and that's obviously a major driver of global expansion and the economy worldwide. How does it translate to New Zealand particularly? Are you expecting similar earnings growth, or is it likely to be a bit more muted?
Look, I think, again, coming back to that point that Fisher made between sort of earnings GDP dependent, economically dependent businesses and things like tech companies, New Zealand is more of a GDP dependent share market. If you think about, the names like your Meridians, even your Sparks and your Choruses, those sort of large cap names in New Zealand, a lot of the property companies, there is benefit if interest rates come down for some of those, but generally it is quite tied to how activity, the wider economic activity. So, we think generally a lot is priced in. The New Zealand share market has gone broadly nowhere for 4 years. So that is a reflection of the economy that's sort of, been working through a reset in interest rates and those sorts of aspects. But, because of that, we think there are pockets of opportunity. And, very much our mantra this year has been to be invested and to remain fully invested. So not to change our asset allocation much. It's been quite fixed to being fully invested, but we still are quite active in our stock selection in terms of both the work that Fisher and International are doing in California and MFS in Boston as our primary external managers, but also in terms of our New Zealand and Australian share portfolio. We are finding names, and we've talked before about sort of names like Ryman particularly, and other ones like Fletcher Building, or in Australia things like sort of ResMed and other businesses like that, which we think really have some really strong opportunities.
Yeah, and the nature of the cash flow generating elements of the New Zealand share market is different from the US, and we've got it's more a New Zealand Inc. story. And
exactly.
Currently, we have incredible immigration numbers coming through, supporting obviously the ability for many companies to be able to sustain strong earnings. Okay, how does this all translate to valuations? Where are they at in the US and New Zealand, and what does that mean then for investors who are continuing to contribute and investing today, or currently obviously have portfolios and are thinking about, what's the direction of my portfolio from here?
Yeah, I might take this in a slightly wider context rather than move away from shares for a little bit, but come back to that, is if we look at valuations generally, we would argue that they're at least normal, if not quite, in some cases very cheap. And if we look at, clearly you're getting paid a lot more for cash, so that's a good starting point. In terms of once you move out the risk spectrum and the maturity spectrum there, if you move into bonds, really you're getting paid the highest amount for bonds that we have basically in 20 years, which is excluding the GFC, which was a period of sort of massive stress, but we haven't been paid sort of 6-7% for bonds for really since the late 1990s. So that's massively attractive from a valuation standpoint, and it really means that that more conservative part of the portfolio, which has been a drag over the last couple of years, because either it wasn't earning much back in 19, 20, etc., or because interest rates have been moving up rapidly and it's really sort of, you've had a capital loss on those assets. That flips around and they become really attractive assets to own, and actually brings back that stability aspect, and that if the world does end up being a more challenging place, those assets have a lot of ability to outperform as interest rates move lower. If I look at shares, generally at its widest sense, have tended to view that a bit like property here in New Zealand, because interest rates were super low in the wake of COVID, and because there was a lot of government spending, you definitely saw prices driven up a lot. 2020 was a very strong market for the shares globally. really a bit like the moves in the housing market. Big move up. You've had a period of quite painful adjustment. Clearly housing in different areas is down somewhere between, I suppose, sort of 5 and 20%, depending on which region. And you've seen that in share markets. And from that point of view, it definitely says that valuations generically are back close to sort of long-time norms. And I will have spoken about it before, but very much our mindset is we use multiple concepts. So how many times earnings are we paying? If a company's earning $100 a year and you're paying $1,000 for it, that means you're paying 10 times earnings. Now, generally, share markets trade on somewhere, depending on which market, somewhere around about sort of 20 times earnings. And after being much in the US case, much closer to 30 times or 30 plus times earnings, they're now back at sort of plus or minus 20 times. So we'd see that valuation being more normal. I think the challenge, to be frank, is looking at the types of valuations, because you really have a little bit of we actually have quite a large dichotomy in the US especially. I sort of touched at the beginning is that if we think about returns this year, that generally actually cash has done pretty well. And in hindsight, if you were all in cash, that's probably been a good place to be. But people will say, well, US share market is up sort of, what was it, up sort of 14% as at sort of close on Friday for the year. That looks like a really good number, and it is a great number. But again, as I said, if we sort of look through some of the detail there, a lot of that has been very focused in those tech businesses. If we go to sort of a wider group of names, and we've talked probably before about the equally weighted S&P, so the normal S&P index is cap weighted, so basically it puts the weight relative to the size of the business. So Microsoft, I don't know the number off the top of my head, but it's around about sort of a 5.5%, 6%. Apple much the same, like Nvidia and Amazon, 3s to 4s. So they really do dominate where that market goes. If we look at it broadly and say, well, we'll take all 500 names and just take 20 basis point weight, so they're all equal, that index is actually down this year. So again, that idea that the broader economy has been more muted, and you sort of see that with the likes of the Dow Jones index, the older sort of more industrially focused index, that's up sort of around about 2%. The New Zealand index is down about 2 this year. Australia's up just under 3. So from that point of view, potentially parts of the tech space valuations are high, but they're growing. The other side, valuations actually are pretty low in many cases. So that was probably a longer answer than you were.
Well, it is really interesting because so much of it turns on how the index is put together.
Correct.
And if you're talking about what the US economy has done, based on stock exchange prices, has done really well. One perspective of it is, the S&P 500 has done really well but as you say, there's 7 companies are really driving that. And then the equal weighted, which is a fairer reflection, arguably, of as an indicator of the broader economy, doesn't look so good. So as a portfolio manager, you need to, you want to be part of the growth, but you also need to be really balanced in how you invest your capital.
Yeah, and that can be a discussion point with clients is, we hold a balanced portfolio, even in the growth space. There are, significant allocations to New Zealand and Australia, which, broadly that's a market that's gone sideways for 4 years. We have allocations to global shares. Parts of the US share market have done very well. Other parts of, global shares have been more muted.
Okay, so our second reason for optimism is declining inflation. And Goldman's came out on Friday, I think it was, with a phrase, the hard part is over. Inflation is now running at about core inflation, which strips out oil and a bunch of other more cyclical components, has moved from 6 to 3% in the US. And their view is that it's going to stay a little bit elevated, but it's heading in the right direction. and it's setting the stage for ultimately rates to start coming down again. Take us through your perspective on this and what that means for us as investors in New Zealand and other economies outside of the US.
Yeah, I think broadly our view is not wildly different from that one that Goldman's is talking about. Is that what has been, I suppose, actually quite remarkable, well not remarkable, but really interesting this year is that actually you have seen that fairly consistent move down in inflation off the peaks across the sort of Western global economies that saw that inflation impulse. And Goldman's made the point, if you look at those economies that experienced a high inflation impulse, basically in September, the 3-month rolling inflation, so sort of where we are in a much shorter space of time, had a sort of a 3% number on it. So very much that's back close to or broadly near the bands that central banks are looking for. So that's why they're sort of saying, a lot of the hard work's been done. They've definitely got on top of it, and I think the positive, as we've sort of touched on before, that I'm talking with, who we spoke with, was it Jared from Kiwibank a couple of weeks ago. The fact that those headline numbers are coming down in New Zealand, we're probably likely to see a headline CPI with a 4 on the front by the end of the year. Might be high 4s, but it'll still have a 4 on the front. Definitely means that, I think the chance of that inflation becoming embedded has definitely diminished. And I think central banks globally will be really comfortable and happy about that. Because, again, and sort of, I'll paraphrase Goldman's for this, they sort of asked the question, well, why has this inflation come down relatively quickly? But at the same time, we've actually still had growth that's been better than expected. And the point they make is that, typically inflation actually comes out of truly overheated economies, just too much demand happening across a wide range of parts of the economy. Definitely we had too much demand, but it was maybe not overheated. It was more really that supply, it was sort of trying to get through the squeeze point. And the flip side is, as supply has sort of opened up, we've definitely had that relief, and you've had that sort of valve, I suppose. The air's moved out of it more quickly than people have expected. At the same time, you've had things like the service economy coming back and other aspects actually sort of helping growth along. So you haven't had sort of probably the same degree of broad-based, even though inflation seemed quite broad-based, it wasn't embedded to the same degree. So that does make us pretty optimistic. I think, again, we've spoken a number of times that we think there are reasons for inflation to remain more elevated. We're not likely to see the sort of 0 to 1% number that we did sort of during the early 2000s, and really that comes back to I suppose ultimately the spending that's going on globally, either through the sort of deglobalization process, people bringing activity closer to home in a similar way, the climate change initiatives, people spending money to bolster the electricity system and find new ways of generating electricity. And the last one is really that government expenditure. There is, across Western nations, there is still decent amounts of government expenditure. It's not like sort of 91 and Ruth Richardson. We're not seeing a contracting in government. Basically, governments typically are expanding still. And especially in the case of the US, they're running a 6 to even 7% budget deficit. So that's a lot of money coming in, which ultimately will be, I think, a lot of that's getting invested for things like that sort of climate change, etc. So that creates just a degree of activity, which I think will keep inflation more elevated, not high, but more elevated. And that's not such a bad thing necessarily.
There's always talk of significant underinvestment in infrastructure across Western economies. New Zealand government's no different from the others. The continuous promises to solve for that, which will bring with it significant continued spending. The other thing is just interesting point you raise about it being continuing to be somewhat embedded, but not to the extent perhaps some originally were thinking. Employment numbers are still really strong, aren't they? And so suggesting that that kind of wage growth still has a bit to play out.
Yes, I think probably the biggest challenge, certainly for markets going forward, is what happens to employment growth. Typically, and again, this is a very US-centric comment, but the US economy, by the nature of the way it's set up, is it is easier to hire and fire people in the US. So they tend to, that unemployment number tends to be more elastic than what we see here. And in that sense, one of the typical challenges is once unemployment starts to rise in the US, often it can see quite a big jump at different points. And I think if we do see that going forward, actually in the short term, employment numbers have been remarkably strong in the US, but if we did see that going forward and unemployment started moving up quite rapidly, that is something I think that would weigh on the market in the short term. But coming back to the wage aspect, I think both that factor and here in New Zealand, really the immigration, which you touched on, have definitely put a bit of a lid on that sort of wage inflation that was ultimately starting to pick up at a bit of steam. You've generally seen across different areas, the switch rate, people switching jobs, has fallen quite a lot. And in New Zealand, because of the population growth that we've seen from immigration, that's definitely meant that employers have been able to fill job vacancies they've had. So, definitely going back through the surveys out there, really, the number one issue facing businesses this time last year and had been for a long period of time was difficulty of finding staff. Now it's more about demand and saying, well, actually, where's my next dollar coming from in terms of things I'm selling, but I've actually got enough employees on board and I'm happy with that. So that's sort of the unknown and something we're watching pretty closely going forward.
Brilliant. The third of our reasons to be optimistic is accelerating technological advancement and what that means for productivity. A couple of elements to this. Tell me when you think about that, what does it mean for you? And you've touched on, obviously, the big seven in the US. That's part of that. Where's it coming from?
I might take it a little bit of a tangent back to your point about investment, and one of the challenges, I think, probably, and hopefully one of the positives that comes out of this general sort of government spending is that we will see more investment in New Zealand's case, in actually just moving things around and be able to sort of businesses be able to do things easier, because that makes their ability makes them more productive, which is good for the economy. And I think ultimately, if we look at productivity and try and rephrase it, it is that issue is trying to make things easier so you can do more. And the clear focus at the moment is artificial intelligence and AI, and that sort of has been coming for a long time, but sort of burst onto the scene in terms of share markets anyway, with a real focus in terms of some of the very it's the right word, some of the very computationally challenging artificial intelligence that has really driven demand for things like the computer chips that NVIDIA makes, that's able to do this at speed and just able to drive that business. But ultimately, if we step back, I think what is interesting about AI, and I'd probably use it in a wider sense, things like general machine learning, is that ability to do things faster and better. And what does make us pretty excited about it is not necessarily the very pointy-headed, for want of a better word, artificial intelligence roles. It's probably the breadth of it. And, as an example, something here, often a lot of New Zealand's exports have sort of missed out on some of the technology side because it's not as applicable to rural New Zealand or things like that. But if you look at, say, the kiwifruit industry, you now have a situation that most kiwifruit orchards would have, I'm going to guess, maybe 1 million individual kiwifruit on the vine at some point in time, and it's really hard to work out how big your crop is. People have gone around and basically counted square meters of how many fruit are in that. Now you can drive along with a 4x4 with cameras, and they count them, and they use machine learning to actually count them, and you can get much better numbers and very, very quickly. So from a productivity point of view, what's the benefit of that? Well, it probably says that you can focus your workforce on specific parts of that property to focus where you need it, and you can sort of, information gives you that ability. So I think it's not something that'll necessarily flow through this year, but as we go forward, and if you think about where the global economy's been over the last 10 years, 10, 20 years, you had that impulse from China. China was bringing new product and cheap product, which in respect was certainly a deflationary force, but also possibly actually a bit of a productivity gain because you got things faster and you didn't have to have inventory. Now, China's not going to do that to the same degree. They're not as cheap as they were, and there's this deglobalization process. But potentially, artificial intelligence offers that opportunity to actually expand across industries and more broadly than we expect, and just at the margin make people's jobs faster and easier.
I read yesterday a synopsis of a study that Harvard did in relation to productivity benefits from AI. And what they did is they got two big teams from Boston Consulting Group, which is one of these huge mega consulting organizations like McKinsey, and instructed one team to use ChatGPT, and the other team were banned from using ChatGPT. And they said, whenever you can, you should use it, and then the other group, obviously, you're not allowed to. And they measured their output over a period and concluded that the team that was using it was 30 to 40% more efficient or productive in terms of their ultimate output over the period, just by accessing information faster and being able to produce data more quickly. And they concluded that that's huge, but it doesn't supplant a person. It enhances the person, because some of the data is not good, as we all know, and it always needs to be analysed and sort of repackaged in a way that is appropriate for the particular task. But I haven't seen people putting numbers on it so clearly before, and from such a reputable organisation, it was obviously getting quite a lot of interest, that particular article. The other thing that just related to this is chip prices. AI and machine learning and all of that requires a huge amount of computational power. And my understanding is that the price of chips just keeps getting cheaper and cheaper. And now there's new advancements. I believe Canon is a big chip manufacturer. They've just come out with a new tool that they think is going to heavily reduce the price of producing chips. And then, of course, NVIDIA and Taiwan Semiconductors and so forth. There's a lot of investment going in there. That is, I guess, one of the foundational pieces to that next step up in productivity.
Yeah, definitely that technology scale and being able to sort of broaden at the moment, the again, use that term, sort of pointy-headed, the chat GPTs, etc., require very specialized NVIDIA chips, and NVIDIA seems to be we've talked about it on different podcasts, one of those businesses that is kind of, fully integrated across the AI spectrum. They make the chips, they have the software that, utilizes bringing those chips together, but increasingly, that's going to expand across the chip industry. And I think from that point of view, it does seem that at the moment they're very clear winners and losers, but actually the cycle in that semiconductor industry is relatively early in the cycle, and there's quite a lot of opportunity for it to broaden out. So from that point, it's we do think it's a positive out there.
Great. Okay, so number 4 on our list of reasons to feel optimistic in the current climate is the strength of the consumer. And we have the US consumer is obviously one, but there are other markets that have huge population bases, India, China, who are also, over the long run, growing in their wealth and their desire to consume. How do you think that influences the outlook for, I guess, global economic growth?
I think generally what has been remarkable this time around is Western consumers especially have actually had been in a really strong position, and that's come through a couple of different ways. One, because of actually, again, probably because a lot of the government subsidies and actions, consumers came through COVID with very strong balance sheets. People had a lot of cash in their bank accounts, basically. So that meant they were pretty resilient to what was happening in terms of the inflation that they were seeing and the increased costs actually in terms of things like mortgage rates, etc. At the same time, you've had certainly in places like New Zealand and the US, actually we talked about sort of wage inflation. You've actually had that wage inflation and employment growth come through. So individually, there's clearly been stresses in places, but actually, say, somewhere like New Zealand, we've had household income growth has been running at around about 10% per annum. So, the consumer has maybe not been happy, but at an aggregate level has been there to actually sustain a lot of activity. And ultimately, Western economies are 60 to 70% consumption, basically consumer based. So if that consumption is happening, then economic activity continues. Somewhere like China is challenging, I think, is the short answer. On one hand, you have this immense savings base, because there's not the same social infrastructure that we have here in terms of unemployment benefits, etc. People traditionally have saved a lot. Being locked down, having much longer lockdown than Western countries, those savings rates have really exploded. So they are sitting on this vast war chest of consumer savings. On the flip side, though, you have an economy there that is struggling to grow. They do have housing issues in terms of there is a readjustment in terms of their property market going on, and people don't have a lot of faith that their traditional way of investing, which is into property in the case of China, is going to be a long-term solution. So that activity is slow. You also have larger forces like demographics. Their population is declining in size. The birth rate is not at a replacement level. So, again, coming back to New Zealand, we've seen population growth this year of close to 2%. That's really helpful to get the wider economy to grow. In the case of China, if their population is declining, that becomes a drag on that economy. So, there are reasons why consumption should be positive, but at the same time, there's some bigger structural factors. So that's a sort of probably a to be decided situation. The interesting one there, which we haven't touched on about inflation, is China historically has exported inflation just because they make goods cheaper than other places. So people substituted away from higher cost places back to China. At the moment, Chinese inflation is non-existent because of that sort of muted growth they're seeing there. So actually, what they call producer prices have been negative for some time. They've got disinflation in producer prices, and they've been skirting. They're back in it at the moment with CPI deflation. So CPI there is basically zero to a small negative. So if we think about global inflation, that's a big country that has got no inflation or disinflation. So it's definitely going to help the inflation side. India sort of is really the opposite in the sense of that population continues to grow fast, and they are consuming more. They're bringing they are parts of that economy are very highly educated. Certainly, productivity, things like AI will help that space a lot, I think, as they sort of probably gives them an ability to expand their capabilities. Maybe even things as simple as sort of call centres, etc. They'll just do more, and they've got the volume of people to do that. So it's a hard one to invest in, but it's definitely a market that will demand product going forward.
Fantastic. And number 5, the final, is what we've classed as the Fed put. Interest rates are higher now, and policymakers and central banks worldwide have more tools in their toolkit, from learnings post GFC, and also having to deal with recent events such as Silicon Valley Bank. Take us through what the central banks can do if things were to become shaky again.
Yeah, I think this is probably something which certainly the general media has not focused on, but we've been through this transition process where we've come from very low, exceptionally low rates to more normal rates, and excuse me, what might be, and again this may be an issue that we find over time, but if we go back to prior to the GFC, we had interest rates like at these levels, and the economy worked happily. Things went along as normal. We got used to very low interest rates. It's been a painful process for interest rates to move up, and that's still working its way through the economy. But it's highly likely, I think, that the economy will actually become more used to these rates and will continue to function pretty normally with these rates. If we go back to the discussion of the Fed put, though, a lot of the activity in the 2000s, and really starting with the GFC, is that because inflation was low, the Fed always, and even the Reserve Bank here, Adrian Orr, etc., always had an ability, if they were concerned about growth and activity, to essentially take their foot off the brake, and in fact even push the accelerator a bit by cutting interest rates, and they were generally pretty quick to do that. Sorry, I should have brought some water. They were generally pretty quick to do that. Over the last 2 years, there's been with interest rates moving up to combat inflation, and with concerns over inflation, it's really the mindset has been that actually, if the economy moves into recession, the Fed won't help us out. There won't be a Fed put because they're worried about inflation. They need to get that under control. Given we're seeing inflation come back and behave in a friendly manner, for want of a better word, and with interest rates at the highest level basically in 20 years, it does suggest that if we're wrong and the world becomes a more negative place, that actually the bright light there is it's easy for central banks to go, well, actually 5.5% cash rates are not needed, the economy's slowing faster than we expected, we're going to cut interest rates. And that'll be that sort of positive, for want of a better word, steroid boost for the economy, for markets, that it will actually go, right, yes, the economy is slowing, but we think things are going to be better going forward. So in some respects, a little bit of the best of both worlds. So I think, and again, coming back to that sort of question of valuations, that process, if we did find activity or economic activity was slowing more than expected, that would probably be a bit challenging for share markets in the short term. It's really good for interest rate markets in the sense that they will increasingly start to price in things like that sort of, central banks cutting rates. That'll be good for interest rates, so that's a positive on that side of the portfolio. And then when that actual interest rate cut comes, you would expect share markets to respond positively. So, for the first time in probably a couple of years, we actually have an ability where central banks can respond. The market will expect that central banks have an ability to respond positively to poor economic news, rather than kind of wanting the poor economic news to get inflation under control.
When interest rates are so low, they don't have any tools there, right? You can't go from zero to, well, you can, but it's not very advisable to go negative, for example.
Yeah. And I think, again, sorry, it probably gets a little technical, but if we go back through the 2000s, a lot of the times inflation was always under their target. So they had the luxury to say, well, yes, if we've been raising rates, inflation's still below target, and if we've got any concern, we'll come off the brake really quickly. Here, we're probably not quite at that degree of responsiveness, but we're definitely seeing positive trends in inflation. And I think if you saw something which would actually increase that disinflationary force, i.e. slowing growth, central banks would respond pretty quickly again, I think.
Fantastic. Okay, so to wrap it up, those are the five. We've got earnings and valuations and where they're currently at. We've got inflation continuing to decline, technological advancement and the impact that has on productivity, strength of the consumer, particularly the US and India, with China obviously facing some challenges, and the Fed put. Collectively, five reasons to be optimistic in an environment where many feel that isn't the case. One thing I just wanted to, before we wrap up, you have been on the road with some advisors recently, and you're talking with how they're interacting with their clients. Clients, from time to time come and they're concerned, they've read something, and they feel like the environment is changing in an adverse way. What do you say to those advisors and how they should, or what tips would you give in engaging with clients in those moments?
Sure. I think in some respects it comes back to the intro and sort of the example of 1991, in that if you're seeing negative returns in markets, often that's pricing in what is happening now or what has happened. Markets by definition are forward-looking, and that is their ability is to drive returns as we go forward. And I think there are always challenges on the horizon, as we saw in 1991. There were lots of challenges, and the share markets worked their way through it. But and I'll be the broken record. At times like this, it's about stepping back and trying to take two aspects to it. One, what are we trying to do? We're trying to stay out of cash and move into assets that over a longer time frame will drive return and actually capture those compound returns. So if you're able to do 7-8% per annum, that will double your investment over roughly a 10-year period. You can't do that in cash. Excuse me. So to do that, the other one is think about it from the flip side as well. One thing I've found interesting is, talking with clients, it can be challenging to talk through negative returns and why that's happened and why we're positive going forward. But if you really sort of think about that as certainly an advisor for a new client, you essentially flip all those discussions on their head and say, well, look, the share market in New Zealand has gone nowhere for 4 years. We have interest rates at very high levels. You can buy bonds cheaply. Shares, because they've gone nowhere for 4 years, are a good opportunity to invest now, and there will be a rocky road going forward. By definition, that's what you're taking on board when you invest in an asset which drives a higher return and has more volatility. But we know over longer time frames that you have an ability to grow wealth by being invested in those assets and staying with them. So that would be the mantra.
Fantastic. And I'm mildly proud of us that we didn't talk about Bitcoin somehow up to this point, which has had an incredible year so far. And for advisors and clients who follow NZ Funds closely, we tend to have a very small slither in our growth portfolios of Bitcoin and other digital assets through time. A believer in being a genuine diversifier and providing a small opportunity there at the right level. And that's gone, I think, it's up 60-something% year to date.
Yep. Again, the core of portfolios will be bonds and shares, and that is always going to be the case. But we do think, as part of a growth allocation in the share space, that you don't want, just like you don't want one share market, you want multiple share markets. You also want assets that have an ability to generate growth-like returns that are not shares. Now, at New Zealand Funds, we want those assets to be liquid and accessible, so we're not invested in private equity or things of that, or private property, etc. So we have focused on assets like commodities, small allocations to things like commodities, and small allocations to things like crypto assets like Bitcoin and Ether. What is really interesting, I think, this year in terms of Bitcoin is fundamentally at its heart, there are no more Bitcoin being produced. So it should have, it's a fixed asset, so there should be a scarcity aspect there. During the hype when it got to 60,000, really it was what you call a risk asset. It definitely followed the high-tech stocks, moved, tech stocks went up and then down, Bitcoin did the same. And this year, it's tended to march much more to its own, to a tune that's different from shares, and in many respects has acted more like gold. The relationship with gold has been much closer. So, because it's got that scarcity, it does have many of the aspects of sort of a digital gold. And, we think it is useful for clients in their growth strategy to have a small allocation to it. And we do think as we continue to move forward, you're seeing more allocations. ETFs in the US are likely to be signed off soon. That is a positive for that.
Yeah. Okay. Well, it is, and it's moving from, I guess, as a asset class, it's moving from socially considered to be a bit fruity to being very institutionalized now, and major clearinghouses and brokers and so forth are trading in it. So, and now we've got BlackRock and Grayscale also looking to issue ETFs, which we think will help it move to the next phase in its broader acceptance, and of course increased demand for the asset. Right, Mark, thank you so much.
My pleasure.
Lots of 5 good reasons to be optimistic, and I hope you have a good week, and thank you everyone for joining.